you just send him a DM. You can find his name. He's one of our lead traders within the group. So just look for his green tag as a lead trader within the A1 trading community. You can send him a DM if you're interested in getting coaching. That is something that he does. So one-on-one coaching is available. Ivan's YouTube channel is here. Thank you very much, Ivan, for coming on the show today, man.
Thank you very much for having me.
All right, we'll see you next time. All right, guys, we're going to now pivot. We got Chris Pulver taking over the show for his regular session here. So we're going to take a quick break. Before we do that, I just wanted to remind everybody, if you are not already inside of the VIP Discord, if that's something you're interested in, it is currently 45% off for the Black Friday sale that we're running right now. So if you have not already taken advantage, it's a one-time fee to join the Discord. You can also get 45% off the Edge Finder if that is something that you're interested in. Our software here that allows us to track market data. Everything is 45% off. We'll drop the link in the chat to speak directly to our support team to get set up for that big discount that we're doing. Again, it's our biggest of the year, so don't miss it. Quick break, and then Chris Pulver is taking over the show.
Where are we going again?
I thought you plugged it into the GPS.
Oh my gosh, what is that? What's happening?
Relax, it was a Pulver alert.
A Pulver alert?
Yeah, you know, Chris Pulver. He teamed up with A1 Trading, and now you can see all of his trades, and it's all through Discord, so I can easily check them anytime on my phone or desktop. Plus, you can get notifications when new messages are sent.
Frank, that's really cool that you can see his signals, but why are you doing that when we're space traveling?
Because I'm bored and we have light years till our next destination.
Another trade already?
Actually, have no idea what that is. We might be in trouble.
Pulver alerts are now available on the A1 Trading website, and for a limited time, you can get them 40% off for the Black Friday sale event. Don't miss out on getting Pulver alerts for the best price anywhere in the galaxy. We're dropping the link to get Pulver alerts 40% off right now in the chat and the description down below.
Nick, Frank, you watching gold?
Roger that, Pulver. We got the alert.
Hey everybody, happy Monday. How we doing? Welcome back. Just posted a trade alert in the Pulver alert section for the A1 Trading Discord. A little credit spread on NVIDIA. We have earnings this week on NVIDIA. Let me post some of the notables here. So this is the earnings week. It's pretty quiet overall. We have like 130 companies, 131 stocks reporting. These are some of the ones that I'm just paying attention to. I'm not doing a crazy amount of earnings reports for them. I have some exposure already on Walmart. We can take a look at Lowe's. That's had some big ups and downs. Home Depot and Lowe's both. Target, kind of the strength of the consumer. We got some tech plays with Snowflake and Palo Alto. I think I already had some profit on Palo Alto. BJ's is like Costco, so I'll take a look at that one. Baidu, I have some exposure on with the China plays. And then NVIDIA is going to be a big one there aftermarket on Wednesday. So I put in a simple credit spread. If price goes up on NVIDIA, great. That's easy peasy. I'm looking at this potentially to actually drop though. Just for, hear me out. We have quite a large bar count between the last time we tested the 200 moving average, which is all the way back here in January 2023. So if we go all the way back here, we have stretched out around 461 bars on a daily time frame. That's quite a bit. And also percentage-wise, we had a nice reversion from the high here in June all the way back to that bottom in August. And that stretch was around 45% away from the 200 moving average. Now, it's been reduced a decent amount from this previous high. We're about 27, almost 28% away. But based on now the stretch of the bar count, I could see, I could see price gapping higher and then fading and just being like really choppy here, trying to make higher highs. We all know that NVIDIA is one of, several stocks that's kind of priced to perfection. It's been, beating expectations by leaps and bounds, and then it started to kind of slowly creep higher. And so that I guess the inability to show that it's multiplying by 3x and 4x. I mean, the market's like, hey, we're going to, we're not going to go gangbusters on NVIDIA to the upside and have these just exponential moves. So I think that the distance away from the 200 moving average, the distance away from the 200 moving average, plus the 473 bars we've gone, it's going to be difficult for NVIDIA to go way, way, way higher. So here's what I'm doing. This is the trade that I just posted. This is a trade that I'm already in. I'm willing to take some shares of NVIDIA. My goal would be I want to own NVIDIA at 110 or less, okay, or less. So in order to do that, I'm going to use my 137 buy put and put in a profit target at $32. Okay, that gives me $32 of credit, which would bring me down from 137 down to 105. And if I were to get assigned at 138, take my 50 cents off the trade, take my $32 off on the long put, that brings me down to a break even of around 110 or so. 110.50 would be my break even. So 110.50 with previous highs near 150. That's good upside potential, plus some decent support around that 200 moving average or even into these August lows. So I am taking the trade with full intentions of wanting to own shares in case for some reason the market drops it. Also, the one thing that would be important to note on NVIDIA this week is it's a big enough stock at $3.42 trillion that whatever happens up or down, we could likely see some movement coming into Wednesday's close because this is an aftermarket earnings report, or Thursday's open. We could see, potentially a 0.5 to 1% gap on the SPY and the Qs because of NVIDIA's market cap and how large it is. So it will definitely be a bit of a swinger this week on whether or not we are filling, gap wise on the SPY. If we fill, use the box here, whether we fill this gap or whether we continue to backfill that election gap, time will tell. Okay, so we still have some other gaps as well. The post-Fed meeting that we had back in September. I think all three of these levels are ripe for the taking. If I look at this chart right here, for example, let me float this out. So I could see price pulling back. Let's say price today is going to drift up here, find the open from Friday, maybe do a gap fill from Thursday's close to Friday's open on the SPY. If we find that level and we fade that level, question is, are we coming back into some fresh lows for the week? Okay, I'm going to remain hedged on my MES and my MNQ positions, which you can see those right here. So I have a long put at 60.25, and then an MNQ, I have a long put. This is actually a long debit spread. So I bought the 21,200 put on the MNQ, and then I sold against that 800 points lower. So I'm looking to see if I can go $464 max risk for about a $1,100 to $1,200 max profit. And I'm looking to see if price will fall kind of deeper into my moving averages. If we have, the volatility somewhere between like 5 and 10%. Off these recent highs, we've had about a 4% correction on the NASDAQ. And let's go to futures here on the SPY or the S&P futures. We are down. We had about just shy of a 3% correction on the S&P. So could that get a little bit bigger? Yeah, sure. Like I said, if we backfill more of the election stuff, then we could pull back 5, 7, 8. I think even up to 10% would be doable. I mean, if we come back to the 200 moving average on the S&P, this is E-mini futures. We'd have a 9.96% correction from top to bottom, finding that 200 moving average, which, by the way, we still haven't tested. This is also 200 and some bars away on the daily, which is, it's not crazy overextended, but it's something to certainly note. 262 bars. On top of that, it's the percentage away. So I talked about this with Nick last week in our November 12th session. We were 12% away. I have rarely seen any move on the S&P where we get anywhere between like 10 and 15%. We rarely get further away than that. I mean, somebody can test me on that, but anytime we've seen big moves away, let's actually have a look here. So how far away do we get on the downside? About 15 to 16% lower on the downside here. Same thing, about 15% lower on the upside. And we had this crazy run from 2020, which was our post-COVID crash melt up. We didn't see anything too much higher than maybe 10%. Yeah, there's 10% there. There was our top out, and there was like a 9% move. COVID, I think we had like the outlier stretch because that was such a wild move. That was from low to high, stretched out about 20+% away, which was pretty interesting. This rally back up to it. about 30% to it. So that, I mean, again, I'd say COVID to be a bit of an outlier. That was the entire, world and global economy coming to a halt. Other than that, I kind of watched this 10 to 15% window. Going into pre-COVID, we were about 9.5%. You can see the crash right here towards the end. We were stretched away around 11.5%. So we're in the same ballpark that I've seen. I'm back into 2014 now, and every time we've seen it stretch away, like this is 2013, super smooth, lots of dynamic support, bull market, and we went X amount of bars. That was a stretch away of 400 plus bars before we ended up correcting and reverting back to the 200 moving average, and we got as high away as only about 7%. So I'm trying to look at some big fat outliers, maybe here on the bear market side during 2008 when things were obviously pretty terrible. We stretched away about 40 to 50%, which on the downside makes more sense. On the upside, it's rare that I've seen anything more than 15%. Okay, does that make sense? Let's see if I'm all right. NVIDIA 150 matter of time. Yeah, I'm not betting against it. I'm just saying that I want to own it cheaper. There's a lot of stocks I wouldn't mind owning cheaper. NVIDIA is one of them. Netflix is another one. Meta is another one. Microsoft is another one. Google another one. It's like my plan for 2025 is a lot to do with high quality money makers, lots of cash, competitive advantage, and even if earnings are lackluster, we still have companies that would be like well positioned for some resiliency. Here's one thing I thought was interesting this morning. This is the 10-year bond versus the 3-month bond. So this is your 10-month or their 10-year 3-month. What I thought was interesting, this is straight off the New York Fed website. Probability of U.S. recession 12 months ahead of term spread readings. Now, this hasn't been updated, but as of October 2024, we were about 50 basis points away. The real-time feed, we're about 17 basis points away. So we're getting much closer from the 10-year and the 3-month, getting back to the zero line, which is, as I've said, a bit of a concern. We go back to the weekly time frame here. I talked about this for the last couple of weeks. This has been on the radar. So not only am I watching the 10-year bond yield, if that goes higher, I think that's going to be a problem moving forward, where it's just going to choke out growth. I mean, it's going to be hard to restructure any type of debt. It's going to be hard to borrow and your primary consumer financing for anything long term. If it's hinging on the 10-year bond yield and it's going higher, that's probably not a good sign. So I just have some cause for concern. And the 10-year and the 3-month, usually within about 12 months, I'm going to use a different color. Usually within about 12 months of this going from inverted to disinverted, inverted to disinverted, inverted to disinverted, same thing here. These black vertical lines represent the start of a recession. Okay, the start of recession. Now that's according to like the fact of we're in a recession. Now, I don't know if the price action of the S&P is starting to go ahead of that, or if this is officially, the market's noting that we're in a recession, then we start to see a downturn. I would imagine that price is going to lead the way. So we'll probably see a turn in the S&P faster than that. But a couple things that stand out. This is the longest inverted yield curve that we've seen on this for over 40 years. This is also the deepest we've seen in over 40 years. So what does that mean? I don't know. I think this is something that's difficult to model, but based on this being an undefeated indicator of every time we've seen this go inverted to disinverted, there has been a recession that's followed. Now, what I thought was interesting on this Fed website is going into this last data point, okay, at 0.53% inverted, which we're now 0.17, the recession indicator, okay, looking 12 months ahead, it has us already looking for January of 2024, April 2024, October 2024, January 2025. Look at these percentages here. Okay, January 2025, recession indicator is now up to around 59.36%. This is a Fed website. April 2025, 52.56%. So even this is calling for, and I don't know, I'm just curious of the timing. Let's say that we get disinverted by the end of the year. Just throwing it out there. Let's say that this 10-year 3-month is above the zero line by the end of the year. Well, according to this, with a 56 to 59% chance of recession, Does it happen immediately, or does it happen within 3 months, 6 months, 12 months? I mean, we don't know. Nobody knows. But I would just be watching closely, right? Because there is a reason that we've gone deeper than usual. We've had some pretty wild and extreme monetary policy over the last couple of years. Certainly since COVID and the recovery from the bear market, the added debt, a lot of things. It's just all been magnified. Everything that's good has been magnified. Everything bad that's been magnified. That's why we've had bubbles and busts for the last 6 years, and that's pretty much been the market behavior. It's either the greatest thing in the world and the easiest stock market to trade, or it's the worst. And my concern is that if we have another spell of the worst, traders and investors need to know how to survive that, as opposed to they make all this money on leverage instruments, and then all of a sudden they see it all disappear. So anyway, borrowed time. That's all I'm putting here as kind of my note. So if we cross the zero line and we get disinverted, I'm just wondering, as a matter of how much longer can we stay at these all-time highs without having some type of fill in, some type of correction, give back something that we've had. Because if you look at the S&P, it's not like we've had a lot of bad stuff happening in 2024. I mean, our last real correction was 2022. Okay, that was it. We had our COVID crash. And as I said, we've had booms and busts, right? So we have a bit of a crash there. We rally up to all-time highs. We have a bit of a crash there, rally to all-time highs. We had our 2022 bear market. We came out of that kind of unscathed after, look, it was a legit bear market, 25 to 35% corrections. But we really haven't had much of a pullback outside of that was a 5%er, that was a 10%er, and then nothing. And we're sitting here at all-time highs with a pullback of like 3%. So to me, the longer and the longer this goes, okay, and the more unchecked this goes, to me, I just look at, okay, well, that's probably a reasonable spot for a topping pattern, if and when one happens, a topping pattern that possibly backfills a little bit. Even this. Think about this from just a pure fib. Okay. And this isn't perfect science or anything like that, but I would take this low to this high and just ballpark it and say, okay, if and when we put in a top, where is a reasonable pullback? A reasonable pullback to the 23% pullback zone, 38% pullback zone. What's interesting is from this low to that post-election pop high, that 50% pullback, which would, in my opinion, be like perfect balance of the market, comes back to like 474. Okay, now that would be a 50% pullback from our 2022 bottom into our new all-time high that we're seeing here in 2024 post-election. Now, can we go higher for the rest of the year? Sure, of course, right? The one thing the market has going for it right now is seasonality. If there's not a lot to disrupt it, then we look to go higher. We melt up, and the market just keeps grinding away. As Nick and Ivan were talking about just before I came on, going into the watch tool, I do think the Fed has the potential to spoil the party. There's two reasons I'm talking about this. Number one, this was up to 85%. The market was almost certain that the Fed would be cutting rates again in December. And now you can see that has gone quite lower, right? 85 now to 58%. And our 15 to 20% probability of no hike is now up to 42. So the pause scenario is increasing with probability. And this will continue to change as we get closer to that December 18th Fed meeting. But I wouldn't be surprised if we come into that Fed meeting with this thing a much closer move to 50-50. Okay. In fact, I wouldn't be surprised, depending on the inflation data that does come in, and we won't know this until December, but before the Fed actually has its meeting, there will be PCE at the end of this month. There will be another round of CPI and PPI data, and then we'll have the Fed meeting. We'll also have non-farm data the first week of December as well. So if those numbers come in hotter or softer, right? So softer labor and hotter inflation, this is likely going to go down. This is likely going to go up. And the Fed, according to this tool, which has not been wrong since 2009, if this goes higher, where the probability is we're coming into December 18th is the Fed's going to pause. They'll likely pause. I do wonder if the market notices that or takes that into account prior to the actual meeting itself. And if the market prices something in towards the end of the year, or the market waits until the Fed meeting to then price in something by the end of the year. So if the Fed pauses in December, I would imagine they're going to pause in January and they're going to pause in March. And until things look a little rosier for the Fed as far as inflation data, I could see the Fed being on a pause cycle through most of 2025 until data shows otherwise. So just saying. So that's a cause for concern. The 3-month versus the 10-year, cause for concern. The recession indicator on the Fed website, cause for concern. So does it make me bearish? No, it just makes me cautious. So what am I doing? I'm buying hedges. I'm making sure I've got some downside protection. I'm not over trading right now. I'm not trying to buy a bunch of stuff at these highs. I'm waiting for pullbacks if we get them. So I mean, I'm going to take a little play out of Buffett's playbook, which is, I may not be intentionally raising cash, but I'm certainly trying to have cash at the ready. So, I mean, for me, having about 40 to 45% of my portfolio in cash, that's a good thing. So I want to keep it there and see if I can strike some good opportunities. And hopefully, if we get some bargain shopping, I want to take advantage of it. If we keep melting up higher, okay, fine. I mean, I'll benefit from it, but I think most people will benefit from it. I just won't be overly aggressive on the upside. Let's talk about some stocks today. Talk about gold, silver, dollar index, oil, things like that. Let's see here. 6,000 SPX forecast. We hit it already. We already hit 6,000. So the forecast has been checked. Okay, we tapped it, we hit it. There's 6,000 plus, and good, mission accomplished. Does it mean that we go higher than that? Who knows? Like I said, seasonality is a very powerful thing. And the famous saying, the markets can remain irrational longer than traders can remain solvent. Look, I'm not sitting here trying to call the top. I'm just being cautious. But if this market melt up is going to keep going and keep going and keep going, that's fine. I'm just going to be cautious going into Q1, Q2 that at some point this rip and pull back and pull back and pull back and pull back at some point runs out of steam. And this is actually, now that I see this, it just hit me. There's a 3-drive pattern that looks just like this. You have a swing, 1, 2, 3, 4, 5. When that 5th wave is done, when this is kind of the 1, 2, 3, 4, 5, guess what happens? 1, 2, 3. You actually have a break in that structure. I could completely see that happening. If this is not the top with that post-election blow-off move, I could see us drifting just a little bit higher. And this is a 1, 2, 3, 4, 5. Let me show you that. So it's just called a 3-drive pattern. See if I can find a picture of it here on the bullish side. There you go. Okay, so 1, 2, 3, 4, 5. And if we're coming into that window, it might look like a channel. It might look like a rising wedge, but just something to be pseudo cautious of on the daily and weekly chart. Okay. So are we going to get any more backfilling this week? Maybe. I think it depends on earnings, even though it's light, 131 stocks, but we have NVIDIA. That's a big one. But we could have NVIDIA, positive or negative. We'll see what the market reacts to. I think it will be interesting to see, can we break the highs this week without any major economic news? Yes, it's earnings, but the Fed is over. I have one other concern. Okay, I'll just keep listing these things to just be like, hey, it's on the radar. It is this. This Truflation reading has not stopped going up. Okay, I have been talking about this in the last 2 months, thinking that the CPI data that comes in from the U.S. is going to be bottomed. And so our CPI equivalent of year-over-year 2.4% has now gone up to 2.6%. Okay. My concern as we go into early December and prior to the Fed meeting on December 18th is that we're going to go up again to probably 2.7 or 2.8, or I would hope not 3%. But what do we have to watch? Watch the 10-year yield. Okay. So the 10-year yield, and watch the 10-year versus the 3-month. Oops, versus the 3-month. I'll just type it out versus trying to freehand this. So things to watch. So the caution watch list for me is we have the 10-year bond yield. Okay, higher is not good. We have the 10-year bond yield versus the 3-month bond yield. Does it disinvert? If so, not good. Okay, typically within 12 months, we've had a recession. Okay, that's over 40 years. What else? Trueflation. So it's third-party measure, but aggressively higher. This has gone from 1.01% to now 2.84%. That's a crazy jump. If there's even a fraction of this that is going to resemble what we're about to see in the CPI year over year, the CPI month over month, the PPI year over year, the PPI month over month, even the core PCE and the PCE year over year, month over month. If we're on a path to see 1 to 1.5 to 2% and higher inflation over these coming months, at some point that's going to choke out growth. Okay, so will the December, so it's actually the November data, right? It's the November data, but the December print be higher. So 2.4 CPI is now 2.6. So will it go higher? We'll find out. Will PCE go higher? The core PCE is supposed to be like this restrictive rate where the Fed's going to bring rates down towards that core PCE. Is that ticking higher? We'll find out at the end of the month. So this is my watch list. This is what I'm cautious about moving into 2025. Okay, the Trump trade, a lot of good stuff got priced in. Fed was cutting rates, market priced it in. Trump's going to win the election, market priced it in. Policy is changing in 2025. Is it good or bad? We don't know. You know, is everyone that Trump is looking to bring in, like Elon Musk is coming in, and RFK Jr. coming in. You got all these other people that I literally see it every day on Twitter and all over the place. Financial Juice has it. Trump is appointing this person, appointing this person. I don't know if they're good or bad. Are they all going to get confirmed? Maybe, maybe not. So there's a lot of uncertainty moving forward. I just want to be mindful of these major things that I think could derail the market. And then last thing would be the Fed. Will they pause in December? Will they cut? Okay. Probability right now stands sliver 60+% that the Fed's still going to cut. I can see that changing going into a pause, especially if inflation data comes in hotter. I don't think there's any way that we could see the December data for CPI and PPI come in hotter and core PC at the end of this month come in hotter, and the Fed's going to look at that and say, like, we should still cut rates. Doesn't make any sense. So unless we're talking about a mild case of hyperinflation. I mean, look, it's already bad. Inflation is already bad. And 2 to 3% trying to say that's tolerable. We've been dealing with high inflation for the last 4 years. So just because it's trended lower does not mean it's gone away. So that's what I'm saying. Mild case of hyperinflation because we got down to the 2+% and prices have returned to normal. But if we start taking 0.5% higher, 1% higher, that affects everything. So could I see the Fed derailing the market a little bit? Sure. This is why I want to be hedged pretty aggressively towards the end of the year, just in case. Also, low volume. If we have some major like thresholds and breaking points in the market, we could see an exacerbated type move where, let's say, the market sold off a quick 3, 4, 5%. We could see some heavy pressure on the market. We could see some heavy profit taking on the market, and I just don't want to be caught off guard. A lot of people think that it's always so easy to trade at the end of the year. Well, I'm not as bullish at the end of this year as I was last year. Okay, and I'm not as bullish now as I was 2 years ago. I think a lot of good stuff has been priced in. I think this market did a fantastic job of making all-time highs. I think we've had 20+% gains on the index, which is phenomenal. So I'm saying it's a pretty good year. If we go up and we melt up higher, awesome. No surprise. It is what it is, and I'll waste a few percent. Maybe a 0.5 to 1% on hedges, but I'll offset that by having additional melt up gains. But if we have something that derails that, as we know, the downside can be way more aggressive and way faster. So if we have, let's say the market drifts up to all-time highs again, and it's another 0.5 to 1% higher by the end of the year, cool. But the concern is that we could be 3 to 5 to 10% lower if this market doesn't cling to these all-time highs. Does that make sense? All right. So just going to take a screenshot here. I think this is important to at least acknowledge that there are some legitimate longer term macro concerns that I'm aware of. And so that way, at least we can say, hey, we talked about it. I know that I'm potentially wasting money on hedges, but if it pays out, that's why I'm doing it. So call me crazy, but that's what I'm doing. All right, I'm just going to save that screenshot for reference in case anybody is interested because we talked about it. And let's get back to the charts, and I'll do a few more charts. I also put in some trades last week. We talked about them on New Zealand dollar and Aussie dollar. I'm looking to look. I'm not looking to aggressively fade the dollar, okay? But based on this, so my Aussie dollar pending orders, I'm trying to get bought in at some of these major support levels. The New Zealand dollar, I've already added into those support levels. So I'm taking some buy positions on New Zealand dollar, Aussie dollar. I'm still going to hold long on my dollar CAD, which right now is pulled back a little bit. We were up to around 41.07. We pulled it back about 50 to 60 pips, but I'm still long on 2 positions on dollar CAD. I'm also still long on dollar Swiss. I'm fine with that pullback, but I'm gonna maintain my long positions. Okay, dollar index. Let's take a look at that. Dollar index. Hawkish ECB comments boost the euro. What did they say? What did they say? I would have not thought hawkish ECB were coming out in the same sentence. Central banks may have to raise interest rates should international tensions intensify and lead to more significant inflationary pressures. Okay, so I mean, it doesn't really sound hawkish. It's more like, oh crap, we started to cut too early. We might have to pause or raise rates because we did the wrong thing. So anyway, all right, let's take a look. So if the dollar gets hit a little bit, then gold's looking pretty good. I've been pretty careful on not rushing into gold. Gold is up a decent amount. I mean, my gosh, it's up 1.81%. Silver is up 2.99%. I've been pretty active on both. I'm not looking short term on either one, to be honest. Don't be surprised if gold does something like this: high, low, lower, high, lower, low. We've also had a decent bar count on gold. We haven't found that 200 EMA in a while. Let me check and see. We did not find it there. So this goes back similar to the S&P. We are sitting at a bar count of around 283 bars. That's decent. That's pretty lengthy. And also our stretch away move from this point right here, we were around 13 to 14% above the 200 moving average. So a little reversion makes a lot of sense. I could see the market, not breaking all-time highs on gold. High, low, lower high, lower low, or maybe it takes a little bit longer. Some type of falling wedge, some type of dynamic support out here towards like 25 or 2400. Way more bullish on gold in that area. Okay, so I'm doing a lot of positioning on gold. I just bought some more shares of GLD, adding in some longer term credit spreads. And I would be more engaged in futures, but I want to get those new contracts for 2025. We don't really have anything out past March, and I want to be out longer term than that. So silver, same type of thing. Nice structure bounce here, finding some dynamic support. I'm looking to see if silver can get back under the highs at 35 to 36. Here's my SI futures feed. Here's my SLV, trying to get this thing up towards $33. Full measure move on silver is all the way up towards 44. So I like silver a lot. I'm staying long. Bitcoin, not quite to the all-time highs, which were around 93.4. We're trading at 91.8 right now. A pullback or a bull flag. I mean, this has been just a rip through the election. Do we have a bull flag here? Maybe. Do we drift higher? Maybe. Do we cross 100K? Maybe. Probably. So that's a big milestone to celebrate. One thing I'm also watching for next year is when the OCC and CFTC are able to approve some options trading on some of those major spot ETFs, namely IBIT. That's a BlackRock one. If I can trade options on that, that will be a big kind of consistent play for me, like every probably month or quarter going into 2025 and onward. So BITO is doing better. I want to see if we break some highs. I've got some good profits running on each one. So here is my BITO is currently up around 21.5, so $21,000. And I've got some shares. They're doing well. And I have some long calls. They're doing well. And I'm trying to hang on to this. This is out to like 2026, so it's not really time sensitive. It's more if we hit 100,000 plus on Bitcoin, then BITO for me in a call option. I'm probably going to take that profit on the call option, and I'll just sit on the shares. I'll sit on the shares. I'll enjoy this crazy high dividend. I know the price gets restructured because of that dividend. But anyway, if they release options on the other ones, then I'll trade those. Coin is moving along really nicely. I've got a couple of trades here. I've got a 111 down here. I've got a 111 over here. I have a debit spread over here. Let me check on those really quickly. So just traded some of those peripheral stocks. My bull call spread is currently up. It's got to be up more than that. Close at 783. Max profit will be $10. So it's not quite there yet. If I can close this thing at $8 out of 10, so 8 minus what I pay for that trade, 372. So 8 minus 372 is a 428 profit. That's over 100% return on capital. That's not bad. If I max this thing out around, let's say $9, it's not quite there, but 9 minus 372, 528 divided by the 372. That's 142% return on capital. Not bad. Obviously, I don't have to do anything. I could just wait. This is a January expiration. So if I don't do anything and we just stay above 230, I get full $6.28 credit on my 111. Same thing, $3. I mean, even if nothing happens here on Coinbase alone, let's just round up to $4, round down to $3, and round up to $4. I've got $11 in credit. If that's just one contract, that's $1,100 in profit without taking a single share of Coinbase. Now, granted, I could own the shares and I can have, $100 of a profit per share, but obviously that's a bit more expensive to tie up, $20,000, $30,000 in cash in order to get some speculation. So trading options, but works out okay. So we'll keep an eye on those. MicroStrategy, possibly pushing back up to recent all-time highs. I got a lot of time in this trade. I'm actually curious where this one's trading at. I got in for a 330 debit. Let me check on this one really quickly. Then I'll take some more requests. I did gold. I did silver. We'll talk dollar. Any currency pairs, let me know. Yep, I did gold, man. I'm just patient. I think gold looks good. I think we're still going to have a correction back into the 2,500, 2,400 zone. I still want to get long and stay long. I'm longer term gold. So for me, any positioning that I do in 2025 on gold is not short term. I'm only interested in accumulating longer term. Do I think gold by 2025, 2026 can get up to all-time highs again? Probably. Do I think we can end up stretching to 3,000 at some point? Probably. But I'm not doing anything short term. Okay. More short term next year would be depending on the futures market. MicroStrategy. Here is my 375 by 390. That's a deep in the money bull call spread. And I am, let's see. I paid $330 for it. Yep, I just need some more time. We'll see. Okay. How long calls to max profit? I mean, it goes all the way to expiration if you want max profit. I'm happy with anything 85 to 90% of profit, I'll probably end up protecting early. But I probably have to wait until December. If price stays where it is or it gets really, really extended, then I can close out for most of that profit because we're so far away that it becomes the probability is so low that it even gets threatened with an out of the money move that it probably gives me 85 to 90%. But I'll wait and see. I'll just calculate that. If I'm 90+% of profit and I still have time left in the trade, I'll probably just take it for capital efficiency's sake. I could take the profit, reallocate, do something else instead of waiting for 1 or 2 months and hope that everything just goes all the way to expiration. Okay. All right. So that's from some of the crypto related things. I'll just revisit gold for the person that was blasting the chat. Okay. Gold looks good. But like I said, I'm not doing anything near term on gold. I patiently waited. Look, this entire run up, all I did was I let my GLD melt up higher and I waited. I didn't do anything there. I just waited and waited and waited. And then finally, we crossed the 21, we crossed the 50, we hit the 100. I got more involved here with the credit spread. I bought more shares of GLD. Patience. So all I'm looking at now is I'm establishing a position here. If we go high, low, lower, high, lower, low, I'm going to establish another position here. There's really nice support at the 200 EMA plus this, just technical trend line. This is why I'm saying 2,500 to 2,400. If gold comes back into that level, I'm interested longer term trying to get back to these highs or go higher. So I'm looking to see if I can position support levels to go back up and retest. And even if we hit these highs again, I wouldn't be surprised if gold does this. Okay, if gold is a range trade for 2025 or a part of 2025, you know. So I don't know. I'm just not crazy speculative. I'm not crazy short term. I'm looking out like I think gold can go higher. I think it's a good play. If the Fed pauses, sure, maybe that helps the dollar boost in the near term. I mean, look, the Fed is going to be dovish. As soon as they truly feel like they have inflation under control, they're going to be dovish. You already sensed it this year, right? What happened this year? The Fed thought that they had everything under control. Labor market was improved. They dodged the bullet back in August when we had that little sell-off and the market recovered quickly. Labor market improved. And they took a victory lap in September to justify cutting rates by 50 basis points. And they still talked about how good inflation was coming down and trending lower and everything's improving, blah, 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 blah. If they pause in December, it clearly shows like, okay, we acknowledge that the battle of inflation is now at a sticking point where we may not see it trending lower without our help. And their help right now is not cutting rates any further, not letting deeper inflation resurface. So I do think that will do some damage to the market if all of a sudden the Fed is going to get more neutral. I wouldn't even say hawkish. I just say neutral. If they go from dovish to neutral, that's enough of a reset to give the market at least a pause. I can see a lot of stocks pausing in the same reason. Are we going dovish? Are we going to pause? What if the Fed raises rates? That's always the threat. So, I mean, what's kind of crazy is as dynamic as the Fed is with how the markets are behaving and how much the markets are manipulated and influenced by the Fed, it seems to be a pretty one-dimensional entity. The Fed either turns the knob up on, putting money into the system or dialing it back. So it's either quantitative easing, quantitative tightening, and then the same thing on monetary policy, whether they cut rates or raise rates. That's it. That's all they can do. Now, that has a huge effect on the market, as we've seen over the years. So, I mean, they say don't fight the Fed, but it's clearly frustrating when it's like the Fed is pivoting frequently. And they're trying to be transparent, but what it's forcing them to do is basically say all the right things, do all the right things. Then if something looks like they're wrong, they're going to backpedal and try to fix it. So it is a very reactive power. And that's what makes a market. There's ups and downs. Okay. All right. Let's take a look at some other requests here. Team, am I out at 11? Do we have Nick Phillips coming on? I can go for a few more minutes. I just want to make sure I'm not cutting into his time. Oil, you're in New Zealand? Sure. Oil is down. We are sitting at, so oil's actually, I take that back. We're at 68.74. I didn't see the open. So we're gapping up 2.7. Okay, we're good. 2.78% up from Friday's close to today's open. Oil is up and just still hanging in there with this floor holding. This means higher inflation. This means lower inflation. I do think this floor is very vulnerable to break below $65 or $66. If we break hard, we could go to $50 real quick. So I do have a play on oil. It's a bull call spread. It's risk defined. If I lose like $240 or $220 or something like that. If I'm right, I'll make $270, $280. But I want it to be risk defined because I'm not trying to sit here and say I'm gonna take shares of oil. I have no interest in owning oil. I think there's way too much out there with the geopolitics and the escalated tensions. Are we going to hold these lows? Are we going to hold these support levels, which have been going on since March of last year? Or are we going to continue to make this high, lower high, lower high, lower high, lower high, lower high? I mean, is that what we're doing? We're just building this thing up into a floor that all of a sudden we break the floor. Now, either that's a bear trap, we either bear trap and squeeze higher, or this breaks and in fact goes lower. And that's where all this pressure has been building and building and building and building, and eventually the floor breaks. So I don't want to be stuck here without anything risk defined. If I'm going long, I'm just buying support, and it's a good opportunity to be bullish. You can buy low, take some profit anywhere above, and kind of have a line in the sand. So, but if the floor breaks, that's why my dollar CAD looks pretty good to the upside, plus dollar strength. BOC is a little bit more dovish than the Fed right now. So oil I'm watching as a bit of a proxy. Dollar CAD I'm still long, and I'm looking to stay long to like 145, 146 even on the dollar CAD. What else? You're in New Zealand. I think that's just more of a range trade. Yep, I don't have anything that I like on this one. We have some major resistance here and support here, and it's right in the middle. So I don't see anything that I like. Either price comes all the way back up to these highs to get a rejection, and I look for a sell trade, or price comes back down to the lows for a buy trade. In the middle, not trying to fight this. I don't know what it wants to do. So try not to trade the noise. And you might look at this and say, I think we have a topping pattern right here. Well, maybe we do, but that topping pattern would have to break that neckline and go all the way back down. So if this ends up going lower, okay, we might break this low and then head lower. That'd be a nice little pattern trade in the near term. Otherwise, I'm just staying out of it. More resistance up here, more support down here in the middle. That's the hardest way to make a prediction because it can go either direction. Okay, either direction. Does the fact the U.S. is going to start drilling affect oil? Obviously, that would affect production, affect supply. And so, I mean, the offset would be if the U.S. starts drilling, but OPEC members say we're not gonna drill, or we're gonna limit supply. I mean, maybe that's an offset. But I mean, the U.S. alone, I mean, what the U.S. is good at is they can produce. Same thing with Saudi Arabia. It just depends on if they can win out versus it's always a battle. It's like OPEC is so powerful. It's essentially a cartel, and there's a lot of manipulation in oil. So with the U.S. drilling, and we've done a lot of foreign drilling, but we can certainly start retapping domestic drilling. And again, for inflationary pressures, that's probably a good thing for the U.S. If we start drilling that brings energy prices lower, brings inflation lower, that's probably a big component to how this, all the dials that add up to inflation. If energy prices are lower in the U.S., that's probably a good thing, But are there environmental concerns that we should care about? Probably at some point we should. That was a whole movement of ESG, but then skeptics call it greenwashing, and it's all a bunch of crap anyway. Maybe it is, but if we drill like crazy, but foreign oil and OPEC members are like, we're not going to touch it. We're not going to do anything. We're going to halt. I mean, it could be an offset. So it's just, I think oil prices are really going to be a byproduct of everything that's happening with all those balances. It's really difficult to forecast. I think the U.S. wants lower inflation, so they have to, try to find ways to bring energy prices down. While other stuff is, as expensive or still potentially getting more expensive. I follow this guy pretty closely. He had mentioned one of the most bizarre and probably one of the most baloney data points this year is that according to the government, healthcare has gone down 29% this year. I don't know anybody that has insurance, but I would say that's complete BS. I have not had anything other than more expensive healthcare for the last 10 years of my life. So I don't know where they get that data point. I don't know if that's some weird report. It's clearly like a weird way they report things. But healthcare companies claim that they're not making any money, and I just think that's insane. So it's wild. I traded on sell gold. What do you think? I don't know. Everybody keeps asking about gold. Okay, if you're selling, you should be out of the trade. Depending on where you sold, it's like that's a really good correction. We already had like a 10% correction, which is one of the largest of the years, by the way. I mean, gold is down. It was down 9% from top to bottom. That's a pretty healthy correction, if you ask me. Now, I'm long gold to be more long term, so I like gold there. If we come back up in range, I'm just going to try to establish some support levels to stay long with. Like I said before, if we have a high, low, lower, high, lower, low, that would make sense in a fifth wave completion. So we have 1, 2, 3, 4, 5. Typically, we have an ABC that pulls back somewhere in this region. So I could see gold pulling somewhere back into that area, and I want to be long from there. So nothing I'm doing in gold is going to be short term. It's going to be out for probably most of 2025 into 2026 if I can. All right. Okay, so we got a little bit of a drift on the day. Looks like, to me, this is a drift back into the Friday open and the Thursday gap. If this gets faded, and I don't know if this is going to be the case, right? NVIDIA is going to be a big mover this week with earnings. And if earnings are good, probably lifts the market higher. Do we break all-time highs? I don't know. If earnings are bad, or we just see the technicals play out in NVIDIA, we still have a gap to fill here. So I could see this pulling up in this area and then getting faded. And if we're going to come back and revisit lows or go lower, that would just be like the post-election gets faded. That's all. So just something to be mindful of on the index and see, if you're trading short term, just a few things to watch for. So that is it. I think that'll do it for me today. I should be on the session tomorrow. I should be good for tomorrow. And then for the next week and a half, I'm going to be out. I will be in Florida for a week, and I will be in Australia for a week. So I have a conference in Australia. If I have anybody that's in the Melbourne area, I'm going to be at an algo conference. If anybody wants to meet up, I'm happy to, it's random, but I'll be in Melbourne for a week. So that will be the week of Thanksgiving here in the US. And then this week in Florida, I'll be in the Tampa area. But yeah, I don't know. We can stay in touch. I'm still going to be trading. I'm still, I've obviously got my laptop and monitors with me. So I'll be trading, I'll be managing. And if I see anything that I like, I'll post some trades in the Pulver alerts. But yeah, we'll keep grinding per usual. Okay. Thanks everybody. Have a great Monday. Let's have a good week, and we'll see you soon. Thanks. Bye.